But if you look at like CIBC, for example, they've got 480% debt to equity and they've got a financial leverage rate of 18.2. So CIBC is actually the most leveraged bank in Canada. Is the Bank of Canada saying that they'll drop rates to zero without actually saying that? We're going to get into that and the banks, because the banks are extremely leveraged right now, and that is something that we have to analyze and discuss. So first of all, Bank of Canada Governor McClem expects damage from tariffs, hence today's rate cut. Obviously, this was last week, but it's very interesting because he said not ruling out an unscheduled rate move if something severe happens suddenly. And I wonder, of course, what that would actually be and entail. Obviously, with the banks as leveraged as they are, that puts everything in a risky position. And you've got to remember, the banks are balancing all their debt on the backs of consumers and businesses that are extremely leveraged and are extremely vulnerable right now. So McClem also said that he does expect some spillover from uncertainty into the housing market. Obviously, this would be obvious because this is going to impact people's jobs. In fact, it's already impacting people's jobs. I've got numerous reports of companies that are laying off workers, and we'll get into that as well, including a major bank. Diversity has served the Bank of Canada very well. Well, let's take a look at that for a second, because obviously interest rates right now, they're coming down. They may be alluding to the fact that they're going to drop rates to zero if something bad happens. I don't hesitate that they probably would do that. But the thing is, I think that'll be a double bottom in the rates, and I don't think we'll ever see rates go that low again after that. And I think if it did happen, it would be a massive mistake. But if we look at what happened with inflation, obviously diversity has not served the Bank of Canada very well. They did not control inflation. They act like they're controlling all these different things, but their core mandate is inflation and price stability. It's not employment, it's not the economy, yet they talk like they have this wide mandate, even wider than the Federal Reserve, when actually it's just price stability and inflation. And I think a lot of that is the political pressure that is there on the Bank of Canada. So very interesting. And then the Wall Street Journal put this out: Canada's big banks raise loan loss provisions, face uncertainty among clients. Now, obviously, they're raising these loan loss provisions, but the fact is they're still in the hundreds of millions and their debt is in the billions, nearly trillions, especially if you add it up of just two or three of the banks. It's over $1 trillion that they have in debt. So they're very, very leveraged. And I want to give you some context on that because I know it doesn't mean a lot when you just hear it like that. But first of all, you have to look at how leveraged households are. So if you look at the leveraging up that has happened since around 2003, 2004, that's when mortgage debt went parabolic. Most of this is obviously on the housing bubble, and it rests on a housing bubble that is fragmented, that is cracking, is bursting. We're seeing people lose their homes. We're seeing the desperation that is happening in the housing market. And that is what all this debt is built on. And you've got private debt to GDP that is also extremely high and has just been built up and built up in this housing bubble. And a lot of that revolves around real estate as well, because the economy is heavily dependent on real estate, and one has to acknowledge that as well. So we're going to Invest in Pro here. You can actually get access to this. By the way, I got an affiliate link in the description. They gave me access to it, and I'm having great fun with it because you can actually see a lot of the metrics about what's going on with the debt to equity ratio, which I think is key here, and the financial leverage ratios. And I've got a few US banks here just to compare it and give you some context. And basically, if you look here, so Bank of America has debt to equity of 263.4%. They're still pretty leveraged at 12 times. But if you look at like CIBC, for example, they've got 480% debt to equity, and they've got a financial leverage rate of 18.2. Now, obviously, you can see Wells Fargo here is in the hundreds of percent, not in in the 400s at 188.5% and 12 on the financial leverage. So obviously what the Wall Street Journal is saying here, yeah, they're raising loan loss provisions, but the fact is that doesn't cover up the insane amount of leverage here. So I put this in a watch list, and you can basically go through the returns, the risk. The risk is really what I've been analyzing, and it does not look good any way you spin it. I mean, Altman Z-score goes from 0 to 5, and some of these are negative, which in fact just means that they're going bankrupt. Now, I don't want to alarm anybody and just get people to think, oh my God, I need to pull out all my cash from the bank. I don't think you need to do that. If any of these big banks go bust, they would be bailed out by the Canadian government in a heartbeat. And yes, bail-ins can happen. So if your money isn't insured, then yeah, you could be subject to a bail-in. But I think that would be political suicide, and I don't think any politician would do it. It's far easier for them to do a bailout, and then basically they can just dilute the currency. And that's where the real risk lies, is in what you're actually holding. And me personally, I just think that's where you've got to have gold as insurance on your money, because really you cannot rely on the government. You can't rely on CDIC or FDIC, all these insurance programs to really protect you, because they're not going to protect you from government bailouts and government stupidity. And I think that's the real key here. So CIBC is actually the most leveraged bank in Canada at 480.2%. And then in order, you basically then are looking at TD at 431.3%. And then you go to Royal Bank of Canada, 366.4%. And then after that, Bank of Nova Scotia, then Bank of Montreal. And then, of course, you're looking at Bank of America and then Wells Fargo. So I put those on there to just demonstrate how leveraged they are. Obviously, they're both at 12 in the United States, and in Canada, they're all over 17, and some of them are over 18 times leverage, which is just absolutely insane. And you have to ask what all of this is built on. And then you've got banks that are cutting jobs. Now, this is very interesting. A lot of people will pin this on HSBC, the fact they did that acquisition and they took a lot of the staff on. But the fact is, if RBC was really growing really quickly, then they would just absorb those staff, because it's quite costly actually to get rid of people. Canada's largest bank says the cuts come amid changes meant to better position RBC to take advantage of our global scale, simplify how we work, and elevate the leaders and talent who will shape our client-focused growth opportunities. Oh my God. It says that as part of those changes, the bank had to make difficult decisions that resulted in an undisclosed number of staff leaving, while others have seen promotions and expanded responsibilities. RBC spokesman Jeff Lanthier says that the changes are unrelated to RBC's $13.5 billion acquisition of HSBC's Canadian operations last year. That takeover came with a regulatory condition that basically they couldn't fire the employees for 6 months. Last month, RBC reported that a jump in trading revenue and other boosts to the business helped lead it to a $5.13 billion profit for the first quarter. So incredibly interesting what's going on there when you take that all in. Obviously, to me, what that sounds like is they're shrinking and reducing their operations. And when they say they're expanding responsibilities, well, yeah, if they reduce managers 4 to 1, and then basically the one guy who's left, he has expanded responsibilities because he has to do the job of the other 3 people that they've got rid of. It's not necessarily a good thing. And in my book, it doesn't really sound good, even though they're making good profits right now. But that can change on a flipping dime with banks. So you have to be very careful. And then Canadian Tire is going to restructure the company for growth, it says, and will close some Atmosphere stores. Canadian Tire says it's rolling out a new strategy that will see it invest $2 billion over 4 years is to restructure the company for growth, but it will also mean the closure of some stores. So again, it's very interesting what's happening. More retail stores that are closing down. They also talk about in here about the tariffs and the uncertainty around the tariffs. And there's definitely a lot of uncertainty around that. And then you've also got TELUS that's offering buyouts to hundreds of workers across the country. And this is the second round of them doing this. So you've got these massive oligarch type companies in Canada that are laying off thousands of workers, and nobody is going, the economy, it doesn't seem that great. And nobody seems to be looking and thinking, we're extremely leveraged here in both households and also in businesses. And that all rests on the banks, exactly like I said. So it's very, very interesting what is going on. It's going to be an interesting dynamic to see how this all plays out. And yeah, we'll have to see. So if you want to take advantage of Investing Pro, by the way, there's an affiliate link in the description. And if you enjoyed this video, I would highly recommend that you check out that video there, and I will see you guys in the next one. Take it easy. Take care, guys. Bye-bye.